Welcome back to The Dive. Our guest today will share some of her thoughts on some of the tools that the Federal Reserve uses, the reverse repo facility, tapering treasuries, and her view about the Fed trading equities and the Chinese market. She was the former advisor to the Dallas Fed, and Quill Intelligence CEO Danielle DiMartino Booth is here. But before we bring Danielle on, just a quick reminder to tap on that subscribe button for me, please. Hey Danielle, welcome to The Dive.
It's great to be here.
It is so great to have you. Okay, so we really admire your ability to explain complex concepts. So we wanted to start off getting your thoughts on some of the tools the Federal Reserve uses. From your view, what is the Fed trying to accomplish with the reverse repo facility?
Well, right now, especially since July 31st, when the United States government shut down, so the Treasury is not able until the debt ceiling is resolved between the two parties of Congress, so that we can have no Treasury bill issuance, Treasury note issuance, or Treasury bond issuance. And we already went into this period with a lack of sufficient amounts of overnight instruments that money market funds mainly could access in order to pay their investors even the tiniest of yield. And so the Fed's reverse repo facility effectively creates a form of synthesized collateral, if you will, that money market funds and other borrowers can access in order to pay to again have a tiny bit of yield. When you have a zero interest rate environment, which we have in most of the developed world right now, trying to find even just a little bit of yield for your safest assets, which is cash, is very difficult. And the Fed's reverse repo facility tries to resolve this problem.
Now we're hearing all this talk about tapering. How does the reverse repo facility relate to tapering? And why is the Federal Reserve still buying treasuries and injecting liquidity if there's already too much cash in the system?
Well, that's a very good question, but it's what kinds of cash are in the system. Maybe there's too much overnight cash in the system. If you will think of quantitative easing as being a bucket. This is my best analogy, as being a bucket, and the Fed is constantly trying to fill up this bucket with excess liquidity of $120 billion every single month. The reverse repo facility, the larger it gets, effectively, the more holes have been drilled into the bottom of this bucket, and money's coming out, which is, if it's a dollar level that is maintained, its own form of tightening, because money's coming out of the system at the same time. But again, there's a disconnect right now because there aren't enough Treasury bills in existence. Treasury Secretary Janet Yellen, the minute she gets the opportunity, when the debt ceiling is resolved, she will immediately issue a flood of Treasury bills to try and alleviate this supply problem. But at the same time, because the United States is the only country in the world right now that pays the highest levels on risk-free assets, such as the 10-year or the 30-year bond, other investors are looking for that kind of yield, and that's why there's demand for that as well. So the Fed is playing two different games. It's a crazy balancing act, and now you start to talk about the taper on top of that, which financial markets will not appreciate at all, because any form of pulling back by market investors is interpreted as being tightening or reducing liquidity. And if we remember the year of 2018, that was not very well appreciated.
Okay, so this week yields are rising, which means institutions are selling treasuries. Where's all the capital going?
Well, so for every buyer, there's a seller, right? And at this point, if you're a public pension in the United States and you're seeing the 30-year long bond is at 2.08, you're saying, wow, this is huge payday time for me. So there's going to be a lot of demand, despite the fact that there are sellers who are saying, gee, I better dump these treasuries because the Fed's threatening to taper because they've gotten behind. Inflation's running too hot, so they're going to have to get in front of this by tapering. The flip side of it is you've had public pensions who've been staring, instead of at a 2.08% 30-year treasury yield, at something closer to 1.5%. So for them, it's like, what? Christmas has come early. So Again, there's going to be balance.
Okay. Well, we also know that you're a former advisor to the Dallas Fed. We have to ask, what are your thoughts on various Federal Reserve presidents trading equities?
Well, this actually came as quite a surprise to me. I was 9 years, I was inside the Dallas Federal Reserve, and each district reserve has its own ombudsman, if you will, has its own general counsel. But the general counsels of individual Federal Reserve districts all tend to maintain the same level of blindness in portfolios, of distance in portfolios. I was at the Federal Reserve during the financial crisis when the Fed was involved in helping companies such as Ford, General Motors, Caterpillar, that were having trouble with financing. So those specific companies at the time were put on the no-no list. I was not allowed to own banks when I was there. Anything that I owned had to be managed independently. I could not have a personal stake in making decisions about anything that was in my portfolio, given my security clearance. So, in one word, I was shocked to see some of the disclosures that were made, especially in a year in which Fed policy was driving the values of these assets through the roof.
So, do you think this is more widespread amongst the US government?
Well, I do think Congress has got a real problem. So I think that if what's going on in the Federal Reserve casts a light on the fact that members of Congress are able to trade as they please and have made tons of money in front of policies they know that will be implemented and become multiple millionaires many times over, because there's no guardrails, because there's no conflict of interest, and because they don't have strictures that they should. I do hope that this Federal Reserve scandal, if you will, bleeds into other areas of the government so that government officials can quit basically gaming the system. There's nothing that's right about that.
Not at all. Okay, so let's talk inflation. We keep seeing companies like Amazon, McDonald's, and Uber are struggling to find workers. Now we're seeing natural gas prices skyrocket. Iron ore is down substantially. Travel seems to be struggling at the moment due to the Delta variant. And we're hearing reports that used car prices are going up again. From your view, how likely is it that the Fed is able to inject so much stimulus into the system and be precise enough to hit an inflation target of around 2%?
Oh, I mean, you're talking about threading the tiniest of needles out there. Just in the space of 20 seconds, you laid out so many differing directions things are going in right now. We were seeing car sales fall for 5 months in a row. Cox Automotive said that nearly 50% of would-be U.S. car buyers right now are suffering from such sticker shock that they're pushing back. But at the same time, to your point, natural gas supplies have not been replenished, whether you're talking about North America or Europe. So you're seeing the cost at the gas pump, as well as what it's going to cost to heat your home, go up. So stagflation is emerging in the developed world. This is not unique to the United States at all. And the Fed is being asked to tighten in order to try and get inflation under control at the same time that the economy is slowing down. It is the worst of possible scenarios for any central banker to have to address, because they're damned if they do and they're damned if they don't.
For sure. Okay, so we have to ask, do you think there'll be any contagion with what's going on in China?
I think that contagion's a funny thing. It happens very, very quickly. So I think that had the Evergrande moment been systemic in nature and had it induced contagion, I think we would have seen that very quickly. What we're witnessing is the level of control that Chinese officials have inside of a controlled economy. And it is something that is very difficult for Westerners to understand, because again, if something of this magnitude, let's call it if Enron had blown up here in the United States all over again, then there would have been contagion all over the world. But yet we're not seeing that in China, because the government is trying its very best to have this be a controlled explosion, if you will.
Interesting. All right. Well, one more thing before we let you go, Danielle. Where can our audience go to find more of your commentary?
Please come to quillintelligence.com. We have a daily that is very quick to read, and it gets you all of the information you need to know about economics and finance in one fell swoop. And if you do not follow me on Twitter at DiMartino Booth, is where you can get, from what I've heard, a free MBA. So come follow me on Twitter.
Perfect. Well, thank you so much for joining us today and sharing your expertise with us, Danielle.
Thank you for having me. Appreciate it.
Thanks so much for tuning in. We'll be back again tomorrow with more great content, so be sure to stay tuned by hitting that notification bell on your way out.